Hello, and welcome to our third quarter market insights video. Similar to past videos, we will dedicate this presentation to covering what happened in the markets during the third quarter, as well as provide everyone with some guidance for things to watch for out of the capital markets for the remainder of the year. My name is Greg Leonberger. I am the Director of Research here at Marquette. I will cover the overview and U.S. economy portion of this video. We start with that section because we think it serves as a natural backdrop to the rest of the capital markets, which will be covered for the rest of the video. We cover traditional asset classes of fixed income, U.S. equities, and non-U.S. equities, then move on to the alternative section of the video, consisting of hedge funds, real estate, infrastructure, private equity, and private credit. Let's start with an overview of the capital markets. We'll talk about performance as well as the dominant themes of what happened in the third quarter. We'll also spend some time talking about the U.S. economy, what we can watch for out of the economy for the rest of the year. This page is a standard periodic table of asset class returns dating back to 2012, as well as numbers for the 5-year and 10-year annualized returns. The themes through the third quarter of 2021 are the same themes we talked about on the halftime version of this video. Commodities and U.S. equities have led the charge. Commodities have bounced back from almost a decade of flat to negative performance. And while this year has been particularly good, we caution investors to look at the longer-term risk and return profile of commodities. Doing so will reveal that commodities, although have been good in 2021, over a 10-year time period, have still been a drag on returns and volatility. Moving on from the numbers, this page covers some of the more qualitative themes from the markets during the third quarter. The Delta variant had an impact on the markets, but more especially on growth. We will see that more on the next page as we talk about U.S. economic growth. Labor shortages continue as companies are still having trouble fulfilling their workforce and recruiting enough workers to be fully functional. Rising energy costs have now emerged as the primary source of inflation rather than used car prices and airline tickets. This is particularly troubling as we head into the colder months of fall and winter. The Evergrande debt crisis initially looked like it would cause a lot of market volatility, and while it did cause some volatility in the short term, it is very likely this will not end up like Lehman did in 2008, having a profound impact on global markets. September did what September normally does, meaning that it was a negative month for equity markets. Of all 12 months in the calendar year, September is the most commonly negative month, and this year was no different. We are closely watching the Fed's announcement of its tapering program in November. We think that will have an impact on interest rates and equity markets. The last thing we are watching is an earnings peak. We think that earnings for S&P 500 companies peaked in the second quarter and will start to drop from this point forward. We will closely monitor what this means for equity returns on a go-forward basis. As I mentioned on the previous page, the impact of the Delta variant has had an impact on expected U.S. economic growth. Estimates have dropped from 7% down to 5.9% for all of 2021 because of the impact of the Delta variant. If we look at consumers as a whole, however, it's more of an optimistic outlook. The financial profile of the average U.S. consumer continues to strengthen, which should bode well for future consumption patterns and GDP growth. Inflation is another hot topic we've spent some time talking about on past videos. Inflation is expected to stay elevated for the short term, although the drivers have changed, as mentioned again on the previous page. September unemployment dropped to 4.8%, which in a vacuum is a very good number. We think the unemployment rate could actually start to bump up again, though, as more workers return to the workforce with the ending of additional unemployment benefits back in September. We continue to watch supply chain bottlenecks, and we think that could have an impact on holiday shopping and gift giving.
Hi, I'm Ben Moore, Managing Partner and the Director of Fixed Income at Marquette Associates. I'll be walking us through the third quarter fixed income outlook. During the quarter, interest rates rose slightly as COVID cases, including the Delta, Lambda, and Mu variants, generally subsided. Spreads generally widened slightly, driven by Evergrande contagion fears and a tech-driven sell-off due to peak valuations. The AG returned 0.05% in the quarter, while high yield gained 0.89% in the quarter. Bank loans were up 1.13%, and emerging markets debt lost 0.7%. In terms of the themes for the quarter, yields across the curve over the quarter rose slightly. Spreads over the quarter tightened for bank loans as inflows generally rose with the expectation of higher interest rates. However, they widened for high yield and emerging markets debt in tandem with a pullback in equities. The economic recovery is well underway as COVID cases turn the corner and vaccines continue to make progress. The Fed signaled that it may likely hold off on phasing out stimulus, at least for the short term. And lastly, concern over Chinese real estate, inflated market levels, geopolitics, and natural events kept volatility elevated. Here we'll take a closer look at interest rates. The top chart shows the U.S. Treasury bond yield curve last September in the green, as it rose to the dotted line as of June of this year, and finally rising slightly from there to the blue as of this September. The steady rise is in conjunction with the economic recovery from the COVID pandemic, showing that the markets expect medium and long-term interest rates to be higher than where they were projected a year ago. The bottom chart graphs the steepness of the yield curve, with the orange bars being the 10-year Treasury yield minus the 2-year Treasury yield. The curve is still upward sloped, but not as steep as it was coming out of the housing crisis in 2009, nor is it flat or inverted as it was going into the housing crisis in 2007. With the continued economic recovery, especially now that we might be in the clear, at least of the Delta, Lambda, and Mu variants, the forwards market is projecting the yield curve to rise over at least the next 4 years. In this chart, the spot Treasury yield curve is shown at the bottom in the blue, with each successive projected future year's yield curve shown in the higher lines. The market is pricing in a sharper rise in short-term yields as it anticipates the Fed to hike rates over this time frame. These projections should be taken with a grain of salt, however, as they have been very inaccurate in the past. Here are the opportunities and risks for fixed income. In terms of opportunities, the still fairly long runway for vaccinations may mean more price appreciation. There is possible additional fixed income total return, as recently widened spreads may provide for spread tightening in coming months. Bank loans may continue to benefit from rising rates with their floating rate feature, and there is still some value in emerging markets debt given the wider spreads. In terms of risks, we expect elevated volatility as well as the taper and liftoff from the Fed. We expect inflation to be elevated in the short term but projected to decline. Finally, higher interest rates may provide for greater yield and income return in the longer term, but may cut into government, corporate, and consumer earnings, a headwind for the shorter term. Spreads across fixed income asset classes have been fluctuating near all-time tights for several months now. The gray bars show the tightest to widest range for the history of each index, with the blue square where spreads are today, and the black triangle signifying the long-term average. Bank loan and emerging markets debt spreads are slightly more attractive, though still expensive versus long-term averages. Lastly, we'll end with key takeaways. Looking back, Chinese real estate debt remains a concern, but not being widely held outside China and the lack of a derivatives multiplier effect mitigate risks. The 10-year has been hovering around 1.5%. The Fed is signaling its eventual taper and liftoff. Looking ahead, we expect volatility to be elevated as Chinese real estate and U.S. debt ceiling uncertainties fully play out. Herd immunity is in sight for the U.S. For the rest of the world, the IMF is targeting 40% fully vaccinated by year-end and 60% by mid-2022. We expect the Fed and other central banks to grow more hawkish. Lastly, with spreads still near all-time tights, the potential for spread widening grows, but the long runway towards herd immunity and more reopening may continue to be a tailwind.
Hi, I'm Colleen Flannery, and I will be reviewing the U.S. equities section of this presentation. U.S. stock indices posted varying results across the size and style spectrums in the third quarter of 2021. Larger, growth-oriented securities eked out a modest 1.2% gain during the period, while all other large-cap indices posted flat to negative returns. The Russell 2000 index, which tracks small capitalization companies in the United States, along with its style-specific peers, felt the brunt of a challenged quarter, falling between 3 and 5.7%. To that point, all major U.S. equity indices fell in the month of September, which has proven to be a difficult period for stocks historically. The Russell 1000 Growth Index fell 5.6% during the month, while the Russell 2000 Value Index was able to protect relatively well during the downturn, falling only 2%. Performance of the S&P 500 from a sector perspective was mixed during the third quarter. The industrials and materials sectors lost the most ground, while the financial sector posted a 2.7% gain for the period. Energy continues to be the strongest returning S&P 500 sector on a year-to-date basis, boasting a robust 43% return since the start of the year, and was the only sector to post positive returns in September. Recent performance for the sector was likely spurred by a rise in the price of crude oil, which surpassed $80 in recent weeks, representing a 7-year high. If interest rates rise and energy companies continue to feel the lifting effect of a tight oil supply, value-oriented sectors like energy and financials may continue to benefit in the coming months. As we discuss the future, it's important to recognize an abundance of risk on the horizon for U.S. equity investors. While the American consumer remains strong due to stimulus and higher personal savings rates, the supply chain mechanics required to meet this strong demand have faltered in recent months. Labor and commodity shortages, clogged ports, and skyrocketing shipping costs, along with a myriad of other factors, have translated into a more than 5% year-over-year increase in the Consumer Price Index. While many U.S. companies maintain the scale and pricing power needed to absorb or pass on input cost inflation, the U.S. consumer will likely bear the brunt of higher price levels. These developments, coupled with inventory scarcity around the holiday season, may lead to consumers feeling a heightened sense of pessimism as it relates to the economic recovery in the United States. Another risk facing U.S. equity markets is the expectation that the Federal Reserve will begin to taper its balance sheet in the coming months. A clear linkage between recent Fed asset purchases and the S&P 500 return can be seen in the chart here. While looking back to the taper tantrum of the mid-2010s may help us gain some perspective, the global financial crisis and subsequent response by the central bank differs from where we are today. As the Fed balance sheet contracted in 2017 and 18, interest rates fell, serving as a tailwind to growth-oriented assets and pushing the market higher. While tariffs posed a threat to markets during that time, today we're battling rising inflation and cost pressures, both of which should put upward pressure on interest rates. While the future is uncertain, it's reasonable to expect choppiness within the equity markets as investors adjust to a less accommodative monetary policy. Despite a multitude of risks facing domestic stocks currently, some of which we just outlined, it is important to note that equities continue to be attractive relative to fixed income securities. Though interest rates have moved upward in the last 12 months, the earnings yield on the S&P 500 remained above the 10-year Treasury yield by approximately 2.4% at quarter end. That said, valuations seen here do remain elevated across large and mid-cap asset classes, while a relative valuation opportunity may exist within small-cap equities. Specifically, the current trailing and forward price-to-earnings multiples on the Russell 2000 index are below or slightly above median compared to their long-term histories. Let's look at why that is. Since the end of February 2021, or at about the 230 trading day mark seen in this chart, the Russell 2000 index has traded sideways, while earnings growth for its constituents continued to rally thanks to a re-emerging economy. This has resulted in meaningful earnings-based multiple compression. Looking back to the global financial crisis, a similar pattern of pause can be observed within small caps after the market bottom. About 10 months after the March 2009 trough, the Russell 2000 index whipsawed amid a volatile 7-month period in which the index fell approximately 6% before going on to generate an additional 30% plus return. While market conditions of the past clearly differ from those at play today, the eerily similar total return pattern is worth considering given potential tailwinds for smaller, more cyclical stocks at present. While September snapped a 7-month streak of positive performance for the S&P 500, the pullback pales in comparison to more significant equity market drawdowns exhibited in years prior. Further, volatility remained relatively low throughout the month, with the VIX achieving levels only slightly above long-term averages. Going forward, investors should be cognizant of risks posed to the markets, including elevated valuations exhibited by most domestic stock indices, the potential for sustained inflation, ongoing supply chain and labor market dislocations, and a more restrictive monetary policy going forward. In light of these risks, we do remain cautiously optimistic about the prospects of U.S. stocks heading into the last quarter of the year.
Hi, I'm Nicole Johnson-Barnes, and I'll be covering non-U.S. equities. After a strong first half of 2021, international equity markets declined in the third quarter, particularly in September as the market digested inflationary pressures, fears of monetary policy tightening globally, and ongoing jitters around China policy reforms. Developed markets, represented by the MSCI EAFE index, slipped into negative territory and returned a negative 0.4% for the quarter. Emerging markets posted a negative 8.1% return after selling off in July on a blitz of Chinese regulatory actions, stabilizing in August, and then experiencing yet another pullback in September on concerns that one of China's largest property developers, Evergrande, was at risk of default. On the next slides, I will discuss performance drivers for the quarter, along with the potential risk and opportunities to be mindful of as we close the year. Developed markets have continued their positive reopening trajectory, with European markets hitting all-time highs in July and Japan's bellwether market barometer, Tokyo's TOPIX index, reaching a 31-year high in September. From a sector perspective, cyclicals continue to lead within the EAFE index. Energy remained on top in terms of absolute return, posting a positive 8.7% for the quarter and positive 23.5% year-to-date. And similar to the U.S. market, energy was the only sector to post positive returns in September. From a contribution to year-to-date total return standpoint, financials were the most accretive, followed by industrials. What drove this performance was a combination of improvements on the pandemic health crisis front, specifically vaccine momentum in Europe and an easing of COVID-19 infections in Japan, expectations of continued supportive monetary policy by way of continued low rates, and rising profitability metrics across several industries. Looking at emerging markets, performance gains made in the first half of the year were reversed in the third quarter. Consumer discretionary, communication services, and real estate were the weakest sectors, largely driven by China and the Xi administration's accelerated pace of regulations on internet platforms, education companies, gaming, and real estate. Investors turned bearish as these common prosperity measures intensified, particularly with the July mandate that China's $120 billion private tutoring industry convert to non-for-profit businesses. What's shown on this slide is a breakdown of the MSCI China Index by sector index weight in the gray bar and sector year-to-date return in the blue bar. Sectors most impacted by the latest rounds of regulatory movements on the right-hand side of the chart, consumer discretionary, communication services, and information technology, all faced extreme downward pressure and posted double-digit negative returns. These three sectors alone represent over 55% of the Chinese market. As we look ahead to the remainder of this year, there are a few things that we're keeping our eye on. Economic data has lost some of its recovery momentum as different regions and countries navigate the Delta variant with varying degrees of success. In the September Interim Outlook Report, the OECD revised its 2021 estimate of real GDP growth for the world, bringing it down from 5.8% to 5.7%. While economic growth has picked up and global GDP has surpassed its pre-pandemic level, output and employment gaps remain in many countries, particularly those emerging and developing nations with low vaccination rates. Additionally, global economies are experiencing significant price increases across an array of commodities and input components, particularly natural gas. There are several factors contributing to the meteoric rise in natural gas in Europe, including lower renewable energy output, climate change mitigation steps already underway, limited supply from Russia, and consumer and business demand rebounding to pre-pandemic activity levels. The knock-on effect has been soaring energy costs in Europe and the United Kingdom, which has threatened to curb production at energy-intensive companies like steel producers, glass makers, and even fertilizer manufacturers, which supply carbon dioxide to the food industry. Higher commodity prices, coupled with continued supply chain disruptions, lack of labor, and soaring global shipping costs, have extended the near-term inflation timeframe, with consumers now facing higher energy bills and higher food costs as winter and the holiday season approach. On a positive note, while valuations remain elevated across all equity markets, we are starting to see multiples decline from their highs within developed non-U.S. markets. In particular, both the EFI and EFI small cap indices are offering, on a relative basis, more attractive valuation than the S&P 500. Current trailing price to earnings and price to cash flow multiples are below to slightly above their long-term historical median. In closing, while the Delta variant has caused volatility in individual countries and regions, we believe that the economic recovery story has more room to run, which should continue to bode well for value-oriented segments of the international market. As we look ahead to the end of the year, we remain optimistic that developed non-U.S. equities will maintain their leg up, backed by broad vaccination adoption and central banks' steadfast position on keeping rates low. We do, however, anticipate continued volatility in emerging markets surrounding the regulatory changes in China, coupled with the rate tightening we've seen in a few developing nations. Lastly, until our global supply chains, commodity volumes, and commodity prices normalize, we expect inflation risk to remain heightened over the near term.
My name's Nat Kellogg. I'm the Director of Manager Research at Marquette Associates, and I'll be covering hedge funds this quarter. Hedge funds produced muted returns throughout the month of September. Equity-oriented strategies, including hedged equity and event-driven, underperformed, but held up quite well compared to global equity markets, which sold off 3 to 5% throughout the month of September. Credit-oriented strategies, including convert, ARB, and fixed income relative value, had the strongest performance for the month, as the equity sell-off had very little effect on credit markets. Merger ARB led the way during the month as merger spreads tightened. This followed a pretty difficult summer when the collapse of the Aon-Willis deal and guidance out of the Biden administration around antitrust caused a widening of most merger spreads. Equity long-short funds modestly reduced both gross and net exposure throughout the month as equity markets sold off. Net equity exposure, which we show you here in the orange line, closed the month at close to 60%, which still remains high relative to historic standards and above where it was a year ago, but is down considerably from the peak at the end of the first quarter. While gross exposure came down during the third quarter, short exposure increased at the fastest pace in almost 2 years, as you can see by the orange bar at the far right of this chart. While low net exposures and increased short positions aided performance during the month of September, the performance of some of the most widely held hedge fund names largely detracted, particularly on the long side, as you can see here in green, which experienced a notable sell-off towards the end of the month. Credit funds held up well, aided in part by the continued recovery in structured credit markets, particularly CLOs. After a very large drawdown in March of 2020, CLOs have steadily and consistently recovered, and that theme continued throughout the third quarter. One of the consistent themes of 2021 has been the explosion of new issuance in the forms of SPACs, IPOs, and restructurings. While SPAC activity has slowed down since the frenzied pace experienced during the first quarter, it is still an active market and increasingly relying on PIPEs, private investments in public equity, which is often financed by hedge funds to help close deals. So looking back, overall hedge fund performance through the first 3 quarters of this year has been strong, although dispersion has been extremely wide. Exposures continue to come down as managers are modestly degrossing and increasing their short positions. Looking forward, the increased amount of issuance we've seen throughout 2021 in the form of IPOs, SPACs, and restructurings certainly gives hedge fund managers a much broader opportunity set on both the long and the short side than they've had in many years. While the number of large distressed opportunities have largely played out, there remain a number of smaller credits that still need to address their balance sheet, giving some runway on the credit side.
Hello, I am Josh Cabrera, Marquette's Senior Research Analyst of Real Assets. I will be covering real estate and infrastructure. Although real estate benchmarks are subject to quarterly valuation lags, surprisingly strong performance across all property sectors has dominated the first half of the year. Sector tailwinds continue to drive outperformance in industrial and multifamily, as well as Western, Southern, and Eastern U.S. Sunbelt regions. Core real estate compares attractively relative to traditional fixed income alternatives. Spreads between cap rates and 10-year Treasury rates narrowed during the second quarter of this year. However, with roughly a 30 basis point retreat in bond yields since the end of the second quarter, cap rate spreads remain above their long-run average over the past 20 years. As a result, credit spreads may have more room to tighten as investors search for yield in a rebounding economy. Given the prevailing sentiment of an interest rate liftoff in the coming years, thereby increasing borrowing costs for market participants, real estate investors are expected to shift the focus to NOI growth as the main driver of absolute returns over the next 5 years. As a result, post-pandemic property bifurcation will likely persist among core Odyssey sectors in the short term. Investor allocations to real estate have continued to trend higher over the years, offsetting portfolio withdrawals from fixed income alternatives. With expectations of low yields on the horizons for other lower risk cash and fixed income alternatives, investors have become increasingly dependent on real estate to provide a much needed source of income. As a result, capital appetites for U.S. core and core plus strategies have grown, serving as value and appreciation stabilizers and offsetting the uncertainty brought upon by the pandemic. Although strong vaccination rollouts may afford employees the option to return to the office by early next year, work from home dynamics have broadly been a negative for future office demand. Tenants seeking leasing flexibility have continued to migrate from Class B and C quality spaces to more premium properties during periods of declining rents and accelerating vacancy rates. In summary, looking back, as efforts to contain the spread of the Delta variants continue, the future of office and retail remain marred with ambiguity. Work from anywhere flexibility and e-commerce penetration have had structural impacts for each sector. Atypical capital interest and availability along with favorable fundamentals have led to historically low cap rate levels across property types, most notably in apartments and industrial. As the opportunity sets within the core Odyssey sectors become more and more limited, investors find themselves gravitating towards alternative sectors in cold storage, life sciences, and medical offices. Higher octane value add and opportunistic strategies have also evolved into more adequate sources of portfolio alpha. Transitory inflation and debt ceiling sentiments could drive allocations for real estate, particularly apartments, whose mark-to-market benefits have historically shown the most adequate inflation hedge during a period of rising prices. Looking ahead, the pandemic period has had a mixed effect on the core sectors. The recent surge in Delta variant cases is expected to delay the recovery in office and retail sectors, but also continue to drive up valuations and rental growth in industrial and multifamily. Capital interest in multifamily, industrial, and alternative sectors should continue to be the main drivers of future transactional activity. In addition, market participants may pivot towards more risky, distressed opportunities in office, retail, and hotels. As the Fed continues to hold interest rates steady, labor shortages may continue to hamper sales growth opportunities as retailers struggle to keep up with pent-up consumer demand and increasing activity. Despite the cloud of unpredictability centered around office vacancy and absorption rates, effective rent growth rates are expected to remain flat. Amenitized office buildings located in secondary and tertiary markets are expected to be the new norm within the sector going forward. And now moving on to infrastructure. While performance continues to be lagged on a quarterly basis, infrastructure returns have exhibited a noticeable rebound at the onset of the year, narrowing the gap with inflation and equity proxies and outperforming the global fixed income index. The proposed U.S. infrastructure bill and additional government funding should drive the long-term demand for traditional and renewable infrastructure assets. The additional financing is expected to increase allocations as investors pursue long-term contracted cash flows and portfolio diversification. Investors should continue to search for yield in the current low interest rate environment. As a result, the infrastructure opportunity set is well positioned to provide stable long-term income and meaningful growth potential. As political discussions continue to evolve, political tailwinds advocating increased government spending towards infrastructure have resulted in renewed discussion of the Biden administration's endorsement of the bipartisan and reconciliation packages. The proposed bipartisan infrastructure bill is expected to have lagged effects for both public and private sectors, as well as favorable labor impacts and offsetting debt implications. In summary, looking back, active deal flow for telecommunications and renewable energy have presented opportunities for a higher proportion of high-octane closed-end funds in the market. Renewable energy and telecommunication assets could experience increases in long-term valuations from the anticipated approval of the Senate bipartisan bill. The ongoing portfolio need for infrastructure allocations is expected to be driven by the prevalent needs for cash flows and fixed income alternatives. Fundraising has exhibited a rise in an evident bifurcation between economically GDP-sensitive assets and contracted revenues. Looking ahead, despite the current political obstacles for the Senate-endorsed bipartisan bill, available levels of dry powder continue to be high, as investors target opportunities in essential clean energy and social sectors. On the likelihood of increased government spending, an alignment of public-private interests will foster growth for elevated deal flow and infrastructure transactions. As the transition towards sustainability and interconnectivity accelerate, market participants will reposition more of their available capital towards renewable energy and smart technology.
Hello, my name is Derek Schmidt. I'm Marquette's Director of Private Equity, and I will walk through the private equity market environment. Due to the lag in market reporting and benchmark collecting, here we are reviewing the Q1 2021 performance numbers. It was a very strong year across the market following the rebound due to the initial COVID pullback. Private equity experienced less of an initial pullback than the public market, but participated in a very strong rebound over the last year. The rebound was strongest in the U.S. and in the venture capital market, which led the way as one of the strongest performing private market sectors, driven by innovation and technology growth, along with adoption acceleration under post-COVID conditions. The private equity market has provided consistently strong performance to investors over a very long horizon, with the upper half of the industry providing very outsized returns relative to the median or over public equities. These historical returns highlight the significant importance of manager selection and access when considering the performance dispersion spread of returns by funds raised each year. While the private equity market continues to remain broadly attractive due to lower relative valuations, we continue to see compelling opportunities within the smaller end of the buyout and venture capital markets, where inefficiencies persist. With more capital flowing into the market and most of it going into larger funds, we see a long runway for capital to be deployed attractively into smaller scale opportunities. However, rising valuations continue to be worth monitoring as the industry's primary concern, with more competition driving elevated transaction prices. This is most prevalent at the upper end of the market, as fewer opportunities are competed for by a growing number of private equity firms. At the smaller end of the market, caution continues to be warranted, with many new emerging managers entering the space. While fundraising in the private equity market slowed during the first half of 2020 due to COVID, it rebounded very strongly in the second half and is on pace for an even stronger first half of 2021. In fact, it is on pace to meet or exceed the 2019 peak, which is the same for both deployments and exits. Not included in these figures is the venture capital space, which experienced a record fundraising in 2020 despite COVID, and is trending ahead of last year's record-setting fundraising pace as capital distributions from large exits continue to be redeployed back into the venture capital market. While public market valuations have pulled back slightly, there remains a large disconnect between the public and private market valuations. The current gap reflects a 49% discount for private market transactions occurring in 2021. However, the valuations on smaller transactions under $100 million in enterprise value have even come down further in 2021 to 7.5 times, providing a compelling opportunity relative to the broader private equity market and public markets. Overall, continued strong demand by investors for private equity continues. The market has regained its stride and is on pace to meet or exceed prior records for fundraising and deployment. Valuations remain elevated, but continue to be well below the valuations experienced in the public markets. Small companies continue to transact around 7 to 8 times EBITDA, which is a significant discount to the overall private equity market at 9.3 times and the public market at 18.1 times. Looking ahead, we see deployment certainly continuing at an accelerating pace due to the level of fundraising and dry powder within the market. Competition at the upper end of the market will persist and remains significant, with capital flowing into successful managers who are raising larger and larger funds. The growth equity space is worth watching as it continues to mature, separating itself by sitting between venture capital and the buyout space. Investor interest in growth opportunities continues to expand as performance has been very strong in this area of the market.
Hello,
I'm Brett Grappy, Senior Analyst at Marquette Associates, and this is the third quarter 2021 market environment for private credit. Reporting on a lag basis, private credit performance in the first quarter of 2021 was relatively flat, exceeding the Barclays Agg but underperforming the Credit Suisse Levered Loan Index and the Barclays High Yield Index by 170 and 50 basis points respectively. Alternatively, over the 10-year time horizon, private credit has produced strong returns, exceeding public fixed income indices but lagging equity markets. Overall, the return and yield premium achieved by investing in private credit remains as a return driver and a risk mitigant for the asset class. Looking at vintage year returns, post-2016, private credit has produced over 8% returns annually, acting as a strong diversifier and complement to both private and public fixed income and equities. Additionally, reviewing rolling one-year IRRs, the first quarter 2020 was the first negative quarter since 2016, but performance has bounced back quickly to produce positive returns in the subsequent quarters. Overall, in 2021, private credit assets under management increased marginally, while dry powder has fell slightly. As noted in an earlier slide, due to the decrease in fundraising, residual cash held by managers waiting to be invested in new opportunities has fallen to its lowest level since 2017, in which lies the opportunity for investors. Private credit capital remains in high demand from counterparties such as private equity sponsors and individual companies, as these borrowers look to finance new acquisitions or finance existing debt at lower rates, providing private credit managers with increased deal flow and attractive investment opportunities. Persistent through the COVID pandemic, private credit is still providing investors with yield and structure premiums relative to traditional fixed income asset classes. Currently, high yield bonds are yielding approximately 4.1%, with the Barclays Agg is yielding right around 1.6%. Investors have to go all the way down on the rating scale to CCC rated bonds to find a comparable yield to private credit, which is currently yielding 6.1%, and which remains well below private credit yields. Furthermore, CCC rated bonds are not only lower in quality than most private credit, but they're also subordinate in the debt capital structure to private credit loans. Driven by low interest rates and lower return expectations across various asset classes, private credit continues to garner investor attention as the search for yield remains front and center. Overall, while private credit performance was flat in the first quarter 2021, the asset class has performed well over the decade, and while fundraising has plateaued in 2019 and fell substantially in 2020, we see signs that 2021 fundraising totals will be strong and could eclipse previous highs, with the fourth quarter traditionally being a strong fundraising period in most years. Most importantly, the asset class continues to prove itself as a value add to institutional portfolios. The need for private credit remains strong as companies, both private equity backed and non-private equity backed, are in need of capital to finance new acquisitions or refinance existing debt at lower costs. All of this against the backdrop of the lack of bank participation in the market. Being top of the capital structure and earning a yield above traditional fixed income remains key selling points for current and prospective investors. While these factors will continue to drive the asset class and attract new capital and new market entrants, we believe the fundamentals will remain intact, and we see many benefits for investors to include private credit alongside their existing fixed income and equity portfolios.
We'd like to thank you for watching this video. We hope it was a good use of your time and it helped everyone understand a little bit more about what happened during the third quarter, as well as what we as a research team are watching for in the capital markets for the remainder of 2021. If you have any questions about the material that was presented in this video, there are a variety of ways in which to have those questions answered. Marquette clients, feel free to ask your consultant for more information. You can also send us an email. For specific inquiries, please send an email to research5@marquetteassociates.com. For more general Marquette-related inquiries, please email marquettemarketing@marquetteassociates.com. Finally, a few comments about next steps before saying goodbye. Please let us know any feedback. We welcome your input. We produce these videos for you, our clients and listeners. We want to maximize the time you spend with us, so if you have suggestions, please feel free to share them. You can subscribe to our channel for for these quarterly market insights videos. You can also register for research email alerts on our website. The address is listed under the third bullet. Once again, we'd like to thank you for spending some time with us, and we will see you next time. Have a great rest of your day.